Hello everyone, welcome to Officers Adda 24/7. My name is Saumya Prakash and today we are again with another unit of Principles and Practices of Banking, where we are going to study about contracts of guarantee, bank guarantee, and what does this mean. So let's start the topic. This is the championship series, as you all know, that where we are bringing all the units of the different subjects which you have to study in your for your JAIIB exams. Please share the link of this video with all your friends and colleagues who are going to register for JAIIB this year and would like to appear for this exam in May 2025. So today we are taking up Unit 31, Contracts of Guarantee and Bank Guarantee. So first of all, what a guarantee means. Guarantee means, as per section 126 of the Indian Contract Act, guarantee is a contract to perform a promise. Somebody is promising or discharge the liability of a third person in case of latter's default. What does this mean? This means that suppose A is having some kind of contract with B and C is ready to give guarantee to B. So in case if A doesn't pay to B in as per the contract, C will be liable to pay to B. Once C makes the payment to B, now C becomes the creditor. C becomes the creditor and A becomes the debtor in this case. Earlier A was debtor and B was creditor, but when A is not making any kind of payment, in that case, if C has given the guarantee, C will take the role of creditor and hand over the money to B for whatever contracts they had, and then C becomes creditor, A becomes debtor, and now A is liable to make payment to C. So this is called contract of guarantee, where one person is giving the guarantee. It is a contract to perform the promise or discharge the liability of a third person in case of latter's default. So here A is defaulting and the liability was to make payment to B, and C came into the picture and he performed the promise. He kept up the promise which A had made, and accordingly C made the payment, but now the role gets reversed. Now C becomes the creditor and A is liable to make payment to C now. So this is contract of guarantee. It is given in Indian Contract Act section 126. In commercial transactions, banks customer are sometimes required to give a bank guarantee. Now there are some features of guarantee. What are the features of guarantee? So one of the features of guarantee is consideration. Consideration means every party will give something for the other. Like, consideration basically means if suppose A is ready to sell his car and B will pay 1 lakh rupees for this. So for this particular contract, the contract which will happen between A and B, consideration to A is that he will get 1 lakh rupees for his car, and for consideration for B is that for the payment of 1 lakh he will receive the car. So mutually these two parties are agreeing on something and each are agreeing on what they are going to offer. So a contract of guarantee must be supported by consideration, and consideration between the creditor and principal debtor is valid and good consideration for the guarantee given by the surety. Here surety will be whoever is giving the guarantee, so guarantor will be the surety, and there will be a mutual contract between two people, and this contract should be based on consideration. Both are agreeing to pay something for the thing which they are actually gaining out of that contract. Now comes what is the liability of the surety. liability of surety is coexistence with that of the principal debtor. Unless it is otherwise provided by the contract, a surety is regarded as favored debtor. So favored debtor means that if A and B had mutual contract, C has given guarantee. So when A will not make the appropriate payment which he had to, then C will become liable to pay, and in that case for B, C becomes favored debtor because he is taking the guarantee of A that if he will not make the payment, C will make the payment, and B can easily take or can take the help of C and recover his dues from C. Whatever dues he had from A, that can be given by C now, and that is why the responsibility is coexistence. The same responsibility, like if A had to pay 1 lakh rupees to B, the same responsibility lies with C also, that if A doesn't pay, then C will make that payment to B. So this is liability of the surety. Now, continuing guarantee. What is a continuing guarantee? Where there is a series of transactions. Where there is a series of transactions, this is called continuing guarantee. This type of guarantee is not limited to one transaction, but there are many transactions involved in it. Suppose you have asked a shopkeeper that you can sell goods to my kids up to rupees 50,000. So up to 50,000, kids are allowed to buy anything from the shop. Maybe suppose it is a stationery shop, and kids can buy multiple things multiple times up to 50,000. Once it reaches 50,000, the shopkeeper will come to the father that you had given us a continuing guarantee that the kids can purchase up to 50,000, and after that he will stop because he will need the payment now. So continuing guarantee means if there are series of transactions allowed, multiple transactions allowed within a guarantee, that is called continuing guarantee. Revocation of a continuing guarantee means that suppose after spending 25,000 itself, after the kids have already purchased stationery worth 25,000, father told shopkeeper that now please stop. Don't give anything to my kids without my permission. So this is called revocation of continuing guarantee. That this can be continuing guarantee can be revoked by the surety for future transactions by notice to the creditor. Here creditor is the shopkeeper. So father is allowed to do that. He can stop the continuing guarantee which was earlier given for 50,000. Now he can stop it at 25,000 and tell to the shopkeeper that don't allow the kids to buy anything more than that. What happens when a surety dies? That is, the guarantor dies. What happens when the guarantor dies? So what could happen when a guarantor will die? When a guarantor dies, the guarantee ends from that date. So what usually the bank will do? Bank will either ask the customer to close the loan, or it can ask for some other guarantor in that case. Because the surety or the guarantee which was given by that particular person, if he is no more, then that guarantee ends from the date he died. Variance in terms of the contract. Any variance made without the surety's consent in terms of contract guaranteed by him between the principal debtor and creditor discharges the surety as to transactions subsequent to the variance. What does this mean? There was a guarantee, there was a contract between A and B for delivering of, say, rice. B will deliver rice to A, and for that rice A had to make payment of rupees 1 lakh. C had given guarantee for this transaction where B will give rice, A will give 1 lakh. Now, without knowledge of C, they have changed the product and they did it. They made the variance, they made the changes that now it will be for wheat. So because C had agreed in case of rice, he was not informed about the changes. Now C is discharged of his surety, discharged of his guarantee which he had given, because he was not made a party of the variance and he had not agreed for this particular transaction. He had agreed for where rice was sold for 1 lakh rupees. So this means that if there is any kind of change which is done after the contract, this will discharge the surety of that particular transaction. Next comes discharge of principal debtor. If there is any loan because of any kind of error or because A had made the payment, like again in the same example we will take that A and B had this contract where B will give rice to A and A will give 1 lakh to B. Now A is discharged of his duty, maybe because he made the payment, or there was something wrong with the contract itself, or there was some other legal position because of which A got discharged of that particular contract. Here, if C had given surety, if A gets discharged, C also get discharged of his duty. So surety is discharged by any contract between creditor and principal debtor. Here B will be called creditor and A is called principal debtor. A is called principal debtor. So by which the principal debtor is released or by any act or omission of the creditor, the legal consequence of which is the discharge of the principal debtor. Forbearance to sue. Mere forbearance on part of creditor to sue the principal debtor or to enforce any other remedy against him does not discharge the surety unless the parties had agreed for such a discharge. Again, take the same example where A and B have a contract where B will give rice for rupees 1 lakh rupees. So rice will be given by B to A and A will give 1 lakh rupees for this rice. C has given surety for this. If there is any kind of default and B is not taking any action against B, this doesn't mean that C is discharged of the duty. He will be discharged of the duty only when A is discharged of that particular loan. So even B is delaying any kind of action against A, the delay in that process does not mean that C is discharged of the duty which he had. Now, surety is entitled to the benefit of every security which the creditor has against the principal debtor at the time when the contract of suretyship is made, whether surety knows of the existence of such security or not. Suppose bank has given a loan. Let's take example of bank now. Bank has given a loan to A where C is the guarantor. C has given guarantee for this particular loan. Loan was of say 10 lakhs rupees. Here bank had taken security of say 8 lakhs rupees. So if this was taken at the time of contract itself, so net responsibility of C will be of 2 lakhs only. Whether he knows it or not, that security worth 8 lakhs was taken, C will be responsible only for over and above amount which is not covered by security. But the only condition is that this should happen when the actual contract was signed. If in the actual contract there was no security available, then A has given his guarantee, then he is liable for 10 lakhs rupees. Even after this contract, after signing of this contract, after few months, bank takes security of 8 lakhs, but C still will be liable for rupees 10 lakhs. So this is what it means. Implied promise by the principal debtor to indemnify the surety. Whenever surety is making the payment, in every contract of guarantee, there is implied promise by the principal debtor to indemnify the surety. If there was a contract between A and B, say the same contract of rice and this 1 lakh rupees, C is surety. A did not make payment to B. C will make payment to B now. C paid to 1 lakh to B. Now C becomes creditor and A becomes debtor. There is an implied indemnity from A to C that if C had to make payment on behalf of A, then A is liable to make payment to C. This is implied in the contract of guarantee. That is the principal debtor. This is called principal debtor and B is called creditor. Now once C makes the payment, he becomes creditor and A is liable to make payment to C. Now there are different kind of bank guarantee. These guarantees which we were studying right now, these are the some of the general rules which are applied, which are taken into considerations whenever we have a contract of guarantee, whether a customer is giving guarantee to the bank or there are three parties into it where one person is giving guarantee to a third party for another known party. So those were the features of the guarantee. Now comes what is bank guarantee. Bank gives guarantee on behalf of its customers where a third party wants some kind of guarantee from the bank. Suppose there is a contract where, again for simplicity we are taking the same example, rice had to be delivered to A, 1 lakh had to be given by A to B for this particular rice. Now B will generate uh, now B has, because B is not sure whether A will make the payment or not, he will ask A to give a bank guarantee. Bank guarantee, and this will be given by bank which is dealing with this customer A. So bank will, depending upon, after assessing everything, after assessment of the loan or assessment of the risk which the bank is going to take, after assessment of that risk, bank will give the guarantee to B that if A defaults, then he can revoke this bank guarantee and take the payment. So there are three different types of bank guarantee. One is called financial guarantee, one is called performance guarantee, one is called deferred payment guarantee. Financial guarantees are those guarantees where some kind of money, like in case of tender, or if there is any kind of earnest money has to be deposited before the commencement of the performance, then that is called financial guarantee. Like in case of tenders, if there is a tender for a highway, government department can ask for the contractors to provide some earnest money, and that earnest money can be provided as a financial guarantee which is provided by the banks. Now this is the case of performance guarantee. So this is called performance guarantee. When bank gives guarantee for a transaction, then bank will have to make the payment, and this is one of the examples of performance guarantee. Here the problem or the risk is that if rice was not of the same quality which A had ordered, still if B revokes the guarantee, bank will have to make that payment. So bank is not responsible for checking the quality which are being delivered. If bank has already given the guarantee for this, bank will have to make the payment if that bank guarantee gets revoked by B. This is called performance guarantee, where a performance is linked to that particular guarantee. Deferred payment guarantee is, suppose a capital expenditure has to be done and it is very expensive. The customer cannot pay the whole amount in single installment. So customer who is buying, that is the buyer. Like suppose here buyer is A and seller is B. B is the seller. So he can, if A is ordering something which is very expensive and he's not able to repay to B in one single installment, in the contract itself, he can ask for payment in installments. So if there is payment in installment, and it is guaranteed by the bank, that is a bank guarantee is issued for making this installment, paying this installment, then that is called deferred payment guarantee. What precautions you have to take while if a guarantee gets revoked, then as a banker you have to ensure that the bank guarantee or the customer which for the amount for which they have revoked the guarantee, you have to check the amount which was guaranteed by the bank. You also have to check period of guarantee. In period of guarantee, there are mainly two periods which are important. One is called validity period and the other is called claim period. What is validity period? Suppose the guarantee was from 1st January 2024 to 31st January 2024. If anything happens within this time period, then only that person can claim the guarantee. Otherwise, he will not. But for claiming the guarantee, bank will provide some extra time also. For this particular period, default should be within this period, and customer can claim maybe 15 days after this or till maybe say 31st January 2025, but not beyond that. So default should be of this particular period. Claim can be done maximum till 31st January 2025. So this is called claim period and this is called validity period. Claim period in a guarantee may be at least 15 days to 30 days. More will be given in case of claim period. There should be proper invocation. Whenever a party invokes the guarantee, there should be few things that they have to keep in mind. That is first that invocation of that guarantee is within the validity period. Invocation period amount is not more than the guaranteed amount because bank will not pay more than what it had guaranteed, and authority which is invoking the guarantee is competent and empowered to invoke that particular guarantee. Now let's solve some questions based on what we have studied so far. So first question is match the following. Financial guarantee, performance guarantee, deferred payment guarantee. In the second section we have these are guarantees that are essentially transaction related contingencies that involve an irrevocable undertaking to pay a third party in the event of counterparty fails to fulfill or perform a contractual non-financial obligation. This guarantee of the bank assures the exporter of the timely payment of the installments. C says these are guarantees issued by banks on behalf of the customers in lieu of the customer's requirement to deposit a cash security or earnest money. Options are 1A, 2B, 3A. 1C 2A 3B, 1A 2C 3B, 1C 2B 3A. We have just read about the financial performance guarantee and deferred payment guarantee. So financial guarantee is where bank is required to give to the customer, where customer has to deposit any kind of cash security or earnest money. So this is A, sorry, C. 1C, performance guarantee is where transaction related to contingency that involve an irrevocable undertaking to pay third party in event of counterparty fails to fulfill or perform a contractual non-financial obligation. This is A. And deferred payment we pay in installments. So this is B. So 1C, 2A and 3B. Right answer is B. Next question is, which of the following are true in respect to the guarantee? A contract of guarantee must be supported by consideration. A guarantee which extends to a series of transactions is called a back-to-back guarantee. Normally, when the surety dies, the guarantee ends from that date. Any variance, change or modification made without the surety's consent in terms of contract guaranteed by him between the principal debtor and creditor discharges the surety as to transactions subsequent to the variance. The surety is discharged by any contract between the creditor and principal debtor by which the principal debtor is released. Options are 1, 2, 3, 5, 1, 3, 4, 1, 3, 4, 5, 1, 4, 5. Which of the following are true in respect to the guarantee? A contract of guarantee must be supported by consideration. A guarantee which extends to a series of transactions is called a back-to-back guarantee. Normally, when the surety dies, the guarantee ends from that date. Any variance, change, modification made without the surety's consent in the terms of contract guaranteed by him between the principal debtor and the creditor discharges the surety as to transactions subsequent to the variance. The surety is discharged by any contract between the creditor and the principal debtor by which the principal debtor is released. So let's see point wise. We have seen a contract of guarantee must be supported by consideration. A guarantee which extends to a series of transactions is not called back-to-back guarantee, it is called continuing guarantee. So this is not correct. Normally when surety dies, guarantee ends from that date. This is true. Any variance made without surety's consent in the terms of contract guaranteed by him between the principal debtor and creditor discharges the surety as to the transaction subsequent to the variance. This is also true. Surety is discharged by any contract between the creditor and the principal debtor by which the principal debtor is released. So this is also true. So right answer is 1, 3, 4, 5. And so C is the right answer. A as surety for B makes a bond to C to secure a loan from C to B. Afterwards, C obtains from B a further security for the same date. Subsequently, C gives up the security. In this case, what is the position of the surety given by A? A can be discharged from his suretyship to the extent of value of security. A is not discharged in this case because the security was not in existence at the time when contract of suretyship was entered into. A can be taken as co-borrower in this case, none of these. Here the answer is A is not discharged in this case because the security was not in existence at the time when the contract of suretyship was entered into. So right answer is B. A, B and C as securities for D entered into three several bonds each in different penalty name, namely A in the penalty of 10,000, B in that of 20,000, C in that of 40,000. Conditioned for B's duly accounting to E. D makes default to the extent of 40,000. How much amount will be paid by each of the surety? A is liable to pay 10,000, B and C 15,000 each. A is liable to pay 10,000, B 20,000 and 10,000. A is liable to pay 10,000 and B 10,000, C 20,000. Each of them will pay equal amounts. So here the thing is, D is the principal debtor, E is the creditor, he is the principal debtor. I'm writing PD for principal debtor. There are three sureties, A, B and C. They all have given guarantee for this loan. A has given guarantee for 10,000 amount. Here the guarantee amount between all of them is not equal. They have given unequal guarantees. So A has given guarantee for 10,000, B has given 20,000 and C has given for 40,000. Now there is a default of 40,000 rupees by D. 40,000 was due and this was defaulted. Now how much payment these surety will give to E? How much payment will be given individually? How much payment will they give to E? So when there is an unequal guarantees given by guarantors, the first person, because he is giving 10,000 guarantee, he will pay 10,000. So A will pay 10,000. Now if B pays 20,000, C has taken more guarantee terms. So C will B paying only 10,000. If B pays all the 20,000, default is of 40,000. A has already made a payment of 10,000. Then the rest amount will be distributed equally between both of them. So in this case, B will pay 15,000 and C will also pay 15,000. So right answer is A. So this is it for today's session. We are coming up with new batch. You can join our paid classes for preparing your JIB exams. So for that you have to go to Adda 24/7 site, and if you have not downloaded the app, then please download the app from Google Play or Apple Store. Then you have to go to all courses, JIB CIB, JIB May 2025, and here you can see that new batches are coming. These batches are available in both the languages, English as well as Hindi. You can also opt for Mahapack, because in Mahapack you get double validity. If you buy it for 6 months, you'll get validity of another 6 months. If you buy it for 12 months, you can get validity of another 12 months. For this, you can go to buy now. You will use the code Y984 and then you have to apply and you will get the maximum discount on it. And with that, wishing you all the best for your exams. Thanks a lot for watching this video. Please do share the link of this video with your friends and colleagues, and also subscribe to the channel if you have not subscribed the channel, because on this channel we bring you a lot of information regarding your JIB, CIB and promotion exams. So thanks a lot everyone. Bye.